If the United States entered a war with Iran tomorrow, your portfolio would react before you even finished your morning coffee. Futures markets would likely drop immediately. The S&P 500 could fall 2 to 3% within hours. The Nasdaq Composite could drop even more. Volatility would spike. Financial news would call it a crash. But here's what most investors misunderstand. Markets do not fall because of war. They fall because of uncertainty. And war creates uncertainty instantly. Now let's talk about the real trigger behind everything. Oil. Iran sits near the Strait of Hormuz. Roughly 20% of the world's oil supply moves through that narrow passage. If conflict threatens that route even temporarily, oil prices could surge very fast. And when oil rises, inflation follows. Higher oil means higher transportation costs. Higher transportation costs mean higher prices for goods. Higher prices reduce consumer confidence. Spending slows. Investment slows. Growth slows. And this is the macro equation markets watch. GDP equals consumer spending plus investment plus government spending plus exports minus imports. When oil spikes, consumer spending weakens. Business investment pulls back. Imports become more expensive. That pressures growth. At the same time, inflation expectations rise. If inflation rises, central banks are less likely to cut interest rates. Higher rates plus slower growth mean lower stock valuations. And that hits growth stocks hardest. The Nasdaq 100 would likely face more pressure than defensive sectors. But here's where it gets interesting. Not everything drops. Energy companies often benefit from higher oil prices. Their revenues rise with crude. Defense contractors like Lockheed Martin tend to perform well when military spending expectations increase. Meanwhile, airlines struggle. Fuel is one of their largest expenses. Travel demand weakens. Margins shrink. So capital rotates. Investors sell higher risk assets. They move into perceived safety. Gold, treasuries, cash. This shift can happen within days. Now let's zoom out historically. During the early stages of past Middle East conflicts, markets dropped first, but once uncertainty decreased and clarity returned, stocks stabilized, sometimes faster than expected, because markets are forward-looking. They price expectations, not headlines. Here is the pattern. Phase 1. Fear. Phase 2. Worst-case scenario pricing. Phase 3. Relief rally when reality proves less catastrophic than imagined. The mistake many retail investors make is selling during Phase 1. Institutions, meanwhile, reposition quietly. By the time panic selling peaks, much of the damage is already priced in. That does not mean markets cannot fall significantly. If oil surged dramatically and stayed elevated, inflation could reaccelerate. That could delay rate cuts, or even force tighter policy. That scenario would deepen the drawdown. But historically, unless global supply chains are severely disrupted for an extended period, markets tend to stabilize once uncertainty becomes a measurable risk. Short-term expect volatility. Medium-term depends on duration and oil impact. Long-term markets follow earnings growth, not fear. So if the United States were to enter a war with Iran, the likely sequence would be this: an immediate market drop, a spike in oil, rising inflation concerns, energy and defense stocks outperform, tech and consumer sectors weaken, then eventually markets begin stabilizing as expectations adjust. The real risk is not the initial decline. It is emotional decision-making. Because fear moves faster than fundamentals, but fundamentals tend to win over time. Investors who remain rational during uncertainty often benefit the most when stability returns. The market does not collapse because of war. It reacts to uncertainty. And once uncertainty turns into clarity, capital moves back in. That is the pattern. And patterns in finance are rarely random. See you in the next episode.